Hey there, Matt the Mortgage Guy here. Want to record a quick video just to talk about, are mortgage rates up? How much are they up? Where do they plan to go in the future? How much does this affect my buying power? All those questions people have. I wanted to get something out there just to talk to the masses about exactly what mortgage rates are doing, what you should expect in the future, and how it may or may not affect you. And surprisingly, how it may affect you positively if you're a buyer in 2021. So without further ado, just a rough estimate, and you can find on many good sites like Mortgage News Daily what the average 30-year fixed is. Now granted, this is an average, so it's average across all lenders, and it's also an average paying very little points. So it's a no point 30-year fixed for a well-qualified buyer. That might have been as low as 2.6 back in January, and that has gone somewhere near 3.1, somewhere about 0.5% on rate uptick in mortgage rates. And your first question might be, why? Well, there's a lot of factors that go into why, but the easiest and simplest explanation, and I like to keep it simple for folks, is that markets kind of bake in what they expect to happen in the future, right? Just like the stock market bakes in if a company talks about future earnings or they have plans to merge with another company, and in the future they're going to do better, that stock price is going to go up. Well, with mortgage rates, whenever the market makers are listening to Jerome Powell and his plans to print money, or they're listening to government folks talk about stimulus, they bake that in. And so the simplest way to explain it is that we expect a big stimulus package. This big $1.9 trillion stimulus package, we expect to see future inflation. Inflation is bad for mortgage interest rates. And so that's already started to get baked in. And that's the simplest explanation. There's tons of other factors that go into it. And, mortgage folks watch the 10-year treasury, and the 10-year treasury kind of correlates with mortgage rates. And so I think it was last August, the 10-year was at something like 0.5%. In January, it was hovering around 1%. In February, the 10-year, I think it hit last week, 1.6%. So as that 10-year treasury goes up, mortgage rates follow. And so we saw that, 2.6 to 3.1-ish upswing for 30-year mortgage rates. So as important as just knowing that mortgage rates went up about 0.5 point. For all intents and purposes, let's call it that. 3.75 or 0.375 on some products. You might even see a 0.625 on other products, but in general, about 0.5% on a 30-year fix, which is what the vast majority of people get. So how does that affect you? How does that affect your buying power? I did some quick math, and if you're borrowing $350,000, I tried to take, I'm in California, prices are higher, but if somebody's buying a house between $400,000 and $450,000 and putting 5 or 10% down, I just took a $350,000 loan amount, and I ran the payment at those two figures, 2.625 and 3.125. And it's about a $95 difference. So a couple things you can take from that. Rates are at historic lows. If you would have been told 5 years ago or 10 years ago that you could borrow money in the low threes, you'd be absolutely ecstatic. So you should still be ecstatic. You shouldn't be bummed that they're not at the bottom of the bottom. And so it's gonna affect your payment by about that much. For folks who are out there and they went and got the max they qualify for, or they got that number, right? They went out and said, what do I qualify for? And it was $480,000 back in January. What you want to do is look at what's the max I qualify with a new interest rate. And I don't really recommend purchasing up to your max, but for some people to buy in the market or in the school district they have to. Quick math that I was running this morning, it's going to lower what you qualify for by about 5 or 6%. So in that $480,000 example, it might hurt you by 25 or 30,000. It might be 455 or 450 purchase price that you qualify for because of a rate increase. You can, and I remember years ago, a strategy we had was that if you're buying that $480,000 house, you pay a point or two to get the rate down to 2.625, and that's available, then you qualify for that. So that is an option out there, is know that when rates go up, you still have the complete rate sheet available to you. And I think I've gone over this in other videos where, a 30-year fix, you can go from 2% to 3.5%. And you can essentially have any rate you want the lower you go in rate, the more you pay up front. You pay less per month because your rate is lower, but you pay more up front to the lender to get that rate. So any questions on that, feel free to answer that. And I've got, how do mortgage rates work and other videos out there. This video is just specifically talking about mortgage rates. And while we're on that topic, I want to touch on something because I've said it in interviews that I've done, and I've said it on my channel, that a bump up in interest rates might just be what this market needs. In Sacramento, we've got a half a month of inventory. In other markets, they've got a month or a month and a half. It's just a problem everywhere, which leads to 15, 20, 25 offers, which leads to 30, 40, 50,000 above ask. I said on multiple occasions that we need more listings and we need less buyer demand. Well, when rates go up, buyer demand does quell. Will 0.5% affect it that much? Probably not, because rates are still great. But if it affects it a little bit, and we get into spring and more people start listing their houses because seasonality in real estate is real, in the spring more people list, this might help. And I hope it does. I've got buyers that I would be really excited for if they were making offers against 3, 4, 5 people instead of 15. Because for buyers it's hard, and it's just a simple supply and demand issue. It's not any more complicated than that. If anybody wants to, throw in fancy words and add extra stuff, so be it, but it's supply versus demand issue, plain and simple. So that's that quick thing. Just be careful. I make honest videos just because when I see stuff online, every single company that's trying to continue the inflow of leads, they're still running the same ads, so they're showing 2.25%, they're showing a 2% on a 30-year fixed. It's available, you have to pay for it, but just know the rates have gone up slightly. So still a great time to buy. There's still trillions of dollars in refinance business that's available because people are sitting in 3.75, 4%, 4% plus. I mean, I still have people come to me all the time with 4.625. They just never got around to refinancing. And those people can save a ton of money. So that's still out there. If you have any questions at all, please feel free to reach out. Matt, M-A-T-T, at mattthemortgageguy.com. That's the best place to send a message. Just go ahead and ask your question. If you're in California, happy to connect and I'm able to lend. If you're outside of California, I'm going to refer you to a great lender in your market because ultimately they can serve you and do a mortgage for you where I can't. But if you're in Tennessee and just want some advice, I'm happy to give it. And it's, really easy to send a message. And I've replied to hundreds of them where, hey, this sounds kind of funky. The loan officer told me this, and that. And I just reply, that's totally common, that you roll in your taxes and insurance or whatever the case may be. So long-winded outro. If you listen this far, I appreciate you. Thanks for watching. Make sure you like this video and you subscribe to the channel. Thanks. Bye.